Hello and welcome to Trade Maestro. Thank you for joining us. We know your time is valuable and we take that very seriously. Our presentation will begin shortly. While we wait, please take a moment to fully prepare for the presentation. First, make sure your audio is working. You should be hearing sound now. Also, please remove all distractions. The information we will be sharing is very important and we want to make sure you get as much out of it as possible. And finally, be sure to have a notepad and pen so that you can easily take notes and write down references that may be discussed. Thanks again for trusting Trade Maestro with your trading education. We will begin shortly. For thousands of years, if somebody wanted to learn a new skill, maybe learn to make boots or horse saddles, how did they learn that skill? They studied with a master. Trade Maestro builds on this tradition, the relationship between the mentor and the apprentice, but we do it all online. The term maestro means master or an artist of consummate skill. And that's what a trade maestro is. It's a person who has mastered the art of trading. I didn't want to create just another stock market trading company that sells classes. I've done that, and I don't think that's in the best interest of my apprentice. I want to walk him through the process of becoming a great trader, and you don't get there with information overload. You get there by doing it, by getting your hands dirty, by putting into practice. That's the only way to build a new skill.
I love how Jeremy teaches. I love the fact that he teaches things in such a real, practical way.
And he made me realize that I can do this.
I remember when I first started my trading journey, and let's just say I blew up at least 2 accounts.
I know this model of learning to trade works. I've had the opportunity to work with people from over 80 different countries.
And I was skeptical at first. I was kind of like, okay, are you sure about this?
I was always chasing stocks. I would always chase the next hot thing and never had an opportunity to get any profit from it.
I've helped people with trading accounts that are just a few dollars, and I've helped people with trading accounts that are over $1 million.
These courses give me a much wider perspective on what is really possible.
And what Jeremy does so well is that he breaks it down in a simple form so it's easy to understand.
They're just regular folks, and if I can teach them, I can teach you.
I didn't want to let someone else tell me what the play was, and I just followed their lead. I wanted to learn it for myself.
My greatest joy is when somebody that I have taught over the last decade, they reach out and they say something like, you won't believe it, but I actually have people that are asking me to teach them how to trade. Is that okay? You think I can teach them?
Working with you taught me that, stocks go through ups and downs pretty regularly and pretty predictable.
The portion that my husband has now been able to take over and own has outperformed the market and is doing better than the rest of our retirement. It is totally life-changing.
Just to think that I touched people, I taught them to do something, I influenced a generation of traders, and now they're taking it forward and they're influencing the next.
At the end of the trade, I ended up making 140%.
Just gives me so much delight and joy knowing that I can still do something with my financial future.
This is not something that's only for other people. I can actually become financially independent.
Not only allow me to make better trades, more lucrative trades, but have more confidence while I trade.
This Trade Maestro membership is excellent because it's got something for everyone. If you're just starting out, or even if you've been trading for a while, you'll find something you like. You need to get enrolled right now. It's affordable. It's comprehensive. And it's risk-free because you can cancel anytime if you decide you don't like it. So if you want to learn to trade the stock market, or if you're looking to take your trading to the next level, you need to get enrolled as a Trade Maestro member right now. The following presentation is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All examples are for the purposes of teaching and are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, and cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. Well, good morning, good afternoon to those of you, if it's already afternoon for you, and welcome to Building Blockchains. It is great to be with you today. My name is Jeremy Whaley. I'm your host, and we are starting our second week, even though it's Thursday. It was actually a week ago today that we started all of this stuff, and it's great to have you join me today, whether you're here on Rumble or if you're over on YouTube or wherever you're coming from. And we got a great show for you today. A lot of stuff going on. Government's reopening, markets are collapsing. I mean, it's an ocean of red out there, and we are so fortunate that we actually get to have a show and talk about it. Here's our agenda today. We're going to talk about market updates briefly. We're going to talk about XRP going public with their ETF. This is fantastic news. We're going to talk about the government reopening, and turns out that the market didn't like that after all. Why is crypto so volatile? That's going to be in our crypto basics section today. And talk about why is it that crypto does these wild swings up and wild swings down. And then I'm going to talk to you about getting alpha with volatility. And I'm going to share with you a core philosophy of trading, something that most people never take the time to learn. But once you understand it, it will transform everything about getting you on the right side of your trades. So I think you're going to love it. I think we got a great show for you today, and I'm excited to be with you. With no further ado, let's do our market updates. And here we are. You can see it is an ocean of red. It is absolutely ugly out there today. Bitcoin down 3%, down 3,239 points. Ethereum down a mere 6.2%, over 200 points. And Solana, 5%. XRP, not as bad. Maybe because of the ETF. I don't know. We'll talk about that. XLM's down. It's all down. It is just an ocean of red. But it's not just in crypto. I had to show you this one. Take a look at this. This is the stock market today. Dow Jones down 650 points. The NASDAQ's down 500 plus. What is going on? Is the world coming to an end? Probably not. I mean, it might be. I don't know. I mean, world's probably, they've been telling me since I was a kid the world was coming to an end. Is today the day? Probably not today, but it is an ocean of red out there, and it can be a little bit scary, but you know, it's not that bad. At least that's my perspective. I'm going to start with the Dow Jones Industrial Average, even though I don't talk about that on this show. I just want to zoom in and show you. You've learned enough if you've been watching for the last week or so. You've learned enough when you see a chart like this that you can identify that, you know, we're trending or we're not trending. And, you know, the crazy thing, even though the Dow Jones is down 651 points right now, that's all that one big red candle. That's it. And you can look through the history here. You can see other big days where it dropped down. The next day it just continued right back up. You know, 600 points on the Dow Jones Industrial Average, it's not that big a deal anymore. Now, when I was a kid, when the Dow was, 3,000 or 5,000, or even when I started trading and the Dow was 10,000, 600-point day, that was a big deal. But today you have to realize that's only 1.35%. 1%. A little bit over 1% in one day. It's not the end of the world. I'm not saying it's good. I'm also just not saying it's that bad. People overreact because of big numbers. And you got to realize that sometimes we react to things that aren't really that big of a deal. And in the same way, it's the same thing with Bitcoin. Now, Bitcoin, we'll talk about where we're going with this, but just from a price action standpoint and from a perspective of value and percentage-wise, take a look at what's going on here. Yeah, we're down almost, well, it was over 3,000 points. That's a scary number to a lot of people. It's like, it's down $3,000. But it's 3%. And 3%, and specifically it's 2.84%. 2.84% in the scheme of things is not really that big of a deal. It's just not, especially when you're dealing with something that will go up 100% and down 50% in a relatively short period of time. And so I say these things to help you understand and to bring your awareness to the fact that it's easy to be distracted by big numbers, but big numbers in and of themselves don't make it good or bad. And that's just the reality of it. Now let's look at where we are in terms of price action. Yesterday, I shared with you this picture right here. And I told you I would start to get a little bit more concerned if Bitcoin started to drop below this primary support here. Well, we're very close to that. We've dropped below it. We are actually right down at what we call the candlestick shadows right now. And if this does not hold as support, then I do start to get a little bit more concerned about the short-term future. You say, well, where are we going? Well, we're just going to look to the left. And right here at 94,000, that's going to be a pretty major turning point right here. So I'll go ahead and mark that on the chart. 94,000, we'll have a major one right down here in the 80s and possibly 75. Now, am I saying, did I just say we're dropping to 75,000? I did not say that. I did not say that. Don't anybody leave here and be like, he said we're dropping to 75,000. I didn't say that. I said if this support doesn't hold, the next support is at 94. That's all I said. Okay, I'm not predicting that. I'm not saying we're going to drop to 94,000. I said if we don't hold at 94,000, then we drop into the 80s. And if we don't hold at the 80s, then we drop into the 70s. That's all I said. I'm not saying that's what we're doing. I'm saying that's what the structure of the market is, and that's where the chart says that the support and resistance is. So we take it all day by day here, and we will continue to do so. But that is what the picture looks like right now as of Thursday afternoon. Ethereum holding strong at support. It's right there at the support level. XRP, same thing. Actually, XRP is well off its support, but well down from some of its highs today. XLM kind of holding strong in the same location. And Solana, this is the other one. I talked about this one yesterday too. Solana has dropped below its support. Pretty good chance I think Solana is going to get down to about 130. And if that happens, I think it'll be a good buying opportunity. I'm a huge fan of Solana. I love that project. I love everything about it. I love operating on the blockchain of Solana. I love transacting. I built my own crypto token on Solana, and some of you would say, well, that's just a meme coin. Actually, no, we have a real utility case, real use case for it. But Solana is an amazing network. It's a phenomenal network. I think one day it probably will take over and put Ethereum, I don't want to say out of business, but put Ethereum on the back burner, because Solana is so much more affordable, so much faster, and it's just a better blockchain all the way around. There's nothing you can say other than it's a better blockchain. The end. All right, folks, that is my market update for today. With no further ado, let's jump into some headlines. We got some awesome headlines today. I'm going to share the first one with you here. This one's coming from Crypto Brief, but it's all over the place. First, spot XRP ETF starts trading in the United States. What does that mean? It's like, ooh, spot XRP ETF just sounds like he's rambling a whole bunch of letters off. Let me come over here and show you. It's XRPC. That is the ticker symbol, and you can see it is from Canary. It's the Canary Funds. I'm going to click on it. You might notice, if you can see it, it's kind of small, but it says NASDAQ. What does that mean? It means, one big red candle. Why do we have one big red candle, you might say? Well, there's one day of trading. One sole day of trading. What is special about this? XRP is, of course, crypto token. What is an ETF? Many of you have never heard this term, especially if you're new to crypto or trading in general. ETF stands for Exchange Traded Fund. If that means nothing to you, fantastic. Let me explain it to you this way. Imagine that we all pooled our funds together and we divided it up just like a mutual fund. And everybody bought into this fund, and we traded it like a fund, because that's what it is. But then imagine that we listed that fund on the stock market, not on the crypto market, but on the stock market. And we could trade the shares just like Apple or Microsoft or anything else. That's what an exchange traded fund is. It is a fund where individuals pool their money together. You can buy and sell it just like any fund. It is traded on the exchange just like a stock. So instead of this being a issue that is the shares of a stock, or excuse me, the stock of a company, it is the shares of a fund that is traded on the public exchange. If you've never traded them before, they're fantastic tools. They're totally putting mutual funds out of business. I don't know that mutual funds have another 10 years, honestly. I mean, I've been preaching against mutual funds for at least the last 15 years. The ETF is the mutual fund of today. I used to call it the mutual fund of the future. It is the mutual fund of today. It makes it easy to buy and sell into these funds. And as of today, here is the amazing information about this. XRP is on the U.S. stock exchange. Now, again, that may not seem like a big story to you, but it is actually an enormous story because up until recently, the only cryptos that could be traded on the U.S. stock exchange were Bitcoin and Ethereum. There's several ETFs that allow people to get exposure to Bitcoin or to Ethereum through the stock market via an ETF. But there's not been for other cryptocurrencies. And in the last several weeks, really, we've had several that have come on. We've got a Solana ETF now. We've got a Litecoin ETF, a Hedra. Now we've got XRP. XRP, many would consider to be the dominant opportunity in terms of crypto exchange. Many would say that it is. No say about it. It is a much faster network than anything Bitcoin will ever be able to touch. The adoption rate on it is huge. It's got a massive following. The possibility of using XRP for cross-border payments is an amazing opportunity. So yeah, XRP has been needing, we've been needing to have XRP on the platform. It's really, I need to look at where we are. I think it's the third highest market cap right now. Bitcoin, Ethereum, XRP. I may be off, but I need to go look at it. But bottom line is it's legit. It's like the most legit, and we haven't had an ETF for it until today. So I'm really excited that's out there for people who just are afraid of the crypto market, but they want exposure to XRP. It's a great way to do it. Like I said, there's a Solana ETF now. There is a Litecoin. We're starting to get a few more. Speaking of Solana and ETFs, another headline, Solana continues to dump despite ETF inflows. Where's the money going? Is Solana in trouble? No, folks. This is just a natural ebb and flow. Don't let headlines like this distract you. Don't let headlines like this distract you. In fact, a lot of funds don't actually buy the underlying currency, or in this case, the currency, but the underlying asset. Like if you look at a lot of silver funds or gold funds or just a lot of funds in general, they don't actually buy the asset. They buy derivatives on the asset. I haven't looked at the Solana ETF to see what it is that they're buying. But just because there's money flowing into an ETF and the underlying goes down, that's not necessarily a bad thing. What the ETF is designed to do, it's basically a derivative that is designed to match what the underlying, in this case crypto, is doing. And so if Solana is going up, the ETF is designed to go up. If Solana is going down, the ETF is designed to go down. That's the function of it. It's not designed to pump up the cryptocurrency. It takes a naive trader to think that, oh, because we're trading an ETF now, that's going to pump up my cryptocurrency. It brings more exposure to it. It brings more demand to it, but it doesn't necessarily bring more actual money flow into the cryptocurrency. Because I don't need to get the mechanics of it. Just understand this headline of Solana dumping despite ETF inflows. Where's the money going? It's a fear headline. Don't let it freak you out, okay? And the other story that I think is a huge story today, I say it's a huge story. Is it really? The government is open again. Whoop-de-doo. And the market collapses. Last week, everybody was saying that the market was struggling because the government was closed. And then when the market went up, nobody said, hey, the market goes up despite the government shutting down. And now government reopens and the market's an absolute ocean of red. maybe the government and maybe the news headline writers will start to realize people are giving you a middle finger. They don't care about the government. No one ever cared about the government. In fact, I have made the argument here on this show in the last week that we could actually operate the entire government on a blockchain. We don't even need the government anymore. They are nothing but succubuses. You know what a succubus is, right? They suck all the life out of you. That's what the government is. So is it a big story that the government is reopened? I actually don't know that it is. I'm not sure I care. But folks, those are our headlines today. Give me your thoughts. Tell me what you think down below in the chat. I may or may not be able to share our chats today. I keep trying and it just doesn't work. But if you got any thoughts on the government shutdown, you got any thoughts on XRP going live with the ETF, any of that stuff, let me know down below. And with no further ado, let's get into some crypto basics today. All right, folks, I want to continue talking about some of the basics of crypto. And in this segment today, what I want to talk about is volatility, and specifically, why is it that crypto becomes so volatile? I remember when I was a kid and I started talking to my grandfather about stocks, and his response was always, they're very volatile. You don't want to invest in that kind of stuff. And, you know, as I grew up initially, that was my philosophy. I was like, volatility is bad. You don't want to invest in that kind of stuff. And as I've heard, you know, all these people over the years, why they don't want to get into crypto, they say it's too volatile. Well, is volatility bad? Number one, that's a question we're going to answer. And moreover, why would crypto be so volatile relative to some other assets that are out there? Let's take an example here. And if you look at this chart that's on the screen, this is Bitcoin since last year. We had 100% gain. Then we collapsed 25%. Then we had another 63% gain, only to see it selling off 17%. And it's even down today below 100,000. I mean, golly, this is volatile. It's crushing me. Well, actually, guess what? Bitcoin's not that volatile, relatively speaking. Take a look at this next chart. This is XLM during the same time frame, a 450% gain, followed by a 54% loss. Then we doubled again, 100% to the upside, 47% to the downside. My golly, how can anybody sustain this stuff? This is crypto volatility, folks. And is it so bad? Well, it depends on your philosophy. If your idea of investing in anything is that you buy it and you hold it and it's going to go up in value, volatility is going to drive you nuts because it's just a freaking roller coaster. But if your idea of investing in anything is that you can buy it and sell it and buy it again and sell it again, volatility is actually your best friend. You have to realize that we make money on price movement. We don't make money by buying and holding something. You make money on the price movement of that asset. So if the asset is, we'll say, $1 and it goes up to $5 and you hold it, fantastic. On paper, you have money, but it does nothing for your bank account. It does nothing for your standard of living. It's just on paper, you've got an asset that used to be worth $1 that's now worth $5. And if you hold that a little bit longer and it goes back down to $1, you no longer have that asset that was $1 that went to $5. You now have an asset that was $1 that went to $5 and back to $1. That's why people hate volatility, because they look at it and in their mind, they say to themselves, this thing was worth $5 and now it has tanked. A more healthy view is what a trader would say. A trader would look at it and say, hey, when it's at $1 and you buy it and it goes to $5, let's sell that sucker. Let's cash out our $4 per share, or in this case, $4 per crypto, per token profit. And when it falls back down, we buy again. That's what traders do. And traders understand that, but long-term buy and hodl investors don't seem to get it. In fact, it annoys them. But you have to realize it's the traders that create the market for long-term buyers and sellers to trade. You got to understand that. You can't hate traders because they're speculators and they're always buying and selling. It is those very traders that you're saying don't buy and sell. It's those very traders that provide the market for you to be able to buy and sell when you need to. And so it's a very healthy dynamic of the market. Let's break down a little bit. Why do we have so much volatility with crypto? The first reason is liquidity. Years ago, when someone presented Bitcoin to me for the first time, and then he also presented XRP around the same time, my response was it's impractical. I did not get into crypto early enough because I couldn't understand, number one, the technology, and number two, I couldn't see how this could be a practical place to trade with such low liquidity. That was the word I told him. I said, there's no liquidity. Now, back then, this was 2011, 2012, back then, it was way more difficult than it is today. Back in 2011 and back in 2012, if I wanted to buy XRP, I had to somehow get my money into Bitcoin. Then I had to get my Bitcoin over to a different wallet that would interface with this exchange. That wasn't even a real exchange, I think, at the time, that would let me get some XRP. And then I had to move that to a cold storage wallet somewhere else. And it was like 9 steps. And I told the guy, it's like, and I could have bought XRP for 2 cents. But I told him, it's like, this is impractical. Why would anybody do that? The joke's on me because he literally bought like 400,000 and I bought 0. And you all know what happened to XRP. And he used to work for me, and now he's sitting on his XRP bag, and I did not buy it at 2 cents like he did. But the point is, the story that I was telling myself way back then was there's no liquidity. It's too hard to get in and too hard to get out. Liquidity is what makes a free market work. If we don't have liquidity, then you just have an asset that you're stuck with. And the thing about crypto that has made it so volatile is, despite the popularity, despite the narratives around it, it actually still has relatively low liquidity when you compare it to something like a SPY ETF, which has literally just a bajillion dollars flowing in and out of it every day. And I know I'm just making numbers up because bajillion's probably not really a number, but you get the idea. There's just so much flowing in and out. And when you look at a typical stock, there's literally millions of dollars flowing in and out every day that's just trading through it. When you look at a crypto trade, and especially many of the non-major coins, so we'll call them the altcoins, there's just not enough liquidity. And if you look at, for example, a couple of weeks ago, whenever, I forget what it was that the president said, but the whole market took a little dump for the day. And in the world of crypto, there were several trades that dumped really, really big. In fact, I can show you on a chart. I think I'll do that because better, rather than just talk about it, I'll just show you. So if you look at this chart over here of XRP, it was this day right here. It was October the 10th, my wedding anniversary. On October the 10th, you can see that long lower candlestick shadow that showed up on XRP. Now, let me explain this to you. The way that candle shadow shows up, the way candles work, that's the opening price for the day. The top is the high. This is the low. And then the bottom here, that's the closing price for the day. So I'm going to draw it over here. But at one point during the day, that XRP candle looked like this. I mean, this sucker just tanked. That's volatility, folks. In one day, it went from $2.80 all the way down to as low as $1.60. And it ended up closing up here at about $2.40 on that one day. Okay, now that is ridiculous volatility. I don't know the math off the top of my head, but that's about 30% roughly. Okay, now on that same day, almost all of the cryptos took a dump. Here's Ethereum. Same day, October 10th, you can see what happened right there if you can see my cursor. Okay, huge bearish candle that day. Take a look at XLM, huge bearish candle. We opened that day at 37 cents. The low was 28 cents. So it dumped 9 cents on a 40 cent stock, so 25%. Everything took a dump that day. You come to Bitcoin. Took a dump, right? Yeah, took a dump. Everybody freaked out. Percentage-wise, what was it? It opened at 121. The low was only 109. It was down like 10%. While everything else was down 20 and 30%, Bitcoin on this day was only down 10%. Why? That's actually that's the point of this show today, is to explain why Bitcoin was only down 10% while all these other cryptos were down 25 and 30% on the same day. and then everything rebounded and kind of came back. Okay. The reason that Bitcoin was down only 10% is not because it didn't react to the news. It's not because of anything other than this one fact. It's more liquid. It's more liquid. It's the point of this slide right here that I can't seem to find. It's the point of this right here. It's more liquid. There's more people trading it. And since there's more people trading it, there's more it's easier to get into and out of. And since it's easier to get into and out of, it didn't take the same hit. When you have a small liquidity pool, there's not a lot of people that are trading it. And so if you have a large number of people that are selling it and there's not a lot of people to buy it, the price just keeps dropping and keeps dropping and keeps dropping and keeps dropping. And it looks very volatile. It is volatile. But the reason is because there's not enough liquidity. And so you hear people saying all the time, there's two stories that people say around crypto. Number one, they tell everybody to hodl, hold on for dear life, never sell. The other thing is you got to pump it. You got to tell everybody about it. It's actually... That story of hodl and pump, those are actually kind of a contradictory, because if you're pumping it, you really don't want them hodling, because hodling means they're never selling. They lock it up. There's no liquidity to it. Okay. So pumping is constantly generating new liquidity, for better or worse. So that is the number one reason that crypto is so volatile, is there's just a smaller liquidity pool. And the nature of crypto right now, where we are in world history at 2025, the nature of crypto is it's going to have a smaller liquidity pool for now. And because of that, it will be more volatile. That's not a bad thing. As you're going to see in the next segment, volatility actually is your friend. Yeah, I said that. Volatility is actually your friend. It's how you make money. But we'll get to that in a minute. Why do we have so much volatility in crypto? Number two, because there's fewer short sellers. In fact, there's very few short sellers. Short selling is not illegal in the United States with crypto, but it's very, very difficult because it involves margin trading, and margin trading gets into the whole regulation field. And once you get into the regulation field, it just becomes a pain in the butt in the United States. Now, outside of the United States, if you're trading on Binance or some other platforms, you can short the Bitcoin market. It's really hard in the United States. And even in the United States, if someone does want to short, typically they're not actually shorting Bitcoin. What they're really shorting is they're going to take a bearish trade with futures or another derivative that actually doesn't provide any real liquidity to Bitcoin itself. I'll give you a quick understanding of that. If you think about, I'm going to just assume that you guys don't know much about how order flow goes, so I'll kind of explain this to you. When somebody puts a buy order in, you have to match it with a seller. Somebody puts a sell order in, you have to match it with a buyer. What if the price just keeps going higher and higher and higher? People keep buying and buying and buying. Well, that's where short sellers come in. Short sellers come in and they are selling when everybody else is buying. And while that might sound like you're betting against it because you are thinking the price is going to go down, what it's really doing is it's creating liquidity. That very thing that I talked about in the first bullet point, liquidity is why we have volatility. One reason we have so much volatility in cryptos, there's no short sellers. Most altcoins don't have any short sellers. So when buying behavior starts happening, there's no one to sell. What short sellers do in a free market is they actually create the free market. They create the supply and demand, and they're really they're preventing the bubble. That's what they're doing. And so short selling is a very important, healthy dynamic in a free market. It's almost non-existent in crypto. Now, when you look at something like a futures contract, and if you Google, how do you short Bitcoin, some of the biggest things that will come up is say, well, you short it with futures. You're not actually shorting Bitcoin. You're not providing liquidity, because a derivative means it's based on another price, but it's not the price itself. So if somebody sells a futures contract on Bitcoin, it doesn't actually sell the Bitcoin. It doesn't provide any liquidity to Bitcoin itself. That's why you continue to see bubbles, basically, where the crypto will run up really big and then it runs down really big, because there's not enough liquidity and there's not enough short sellers to sustain it. That's why. This is what you're experiencing. So people who say short selling should be illegal, first of all, they don't know what they're talking about. But for people who think that short selling should not be legal in the stock market or any other market, what you don't realize is you would have this kind of volatility in every market. One of the reasons the stock market is more stable is because there's more short sellers. That's one of the reasons that there is stability there, because there's the opportunity for somebody to come in. Even just the idea, there's an opportunity for somebody to come in and short and sell the market to these buyers who are pumping the price up. So those are the two of the biggest reasons that we have so much volatility. Another one, I've kind of already mentioned it, is HODL. The HODL mindset, the HODL mentality literally leads to a bubble. If you buy XRP or you buy Bitcoin or any other coin and you think to yourself, I'm never selling this, what you're doing is you're taking liquidity out of the market. It leads to a bubble. And then to what end? Because you're hodling, you're never going to sell, you're never going to take your profit. So to what end? What good does it do to even hodl? All it does is actually help continue the volatility of the bubble. And I think this is so funny. The people who complain the most about volatility in crypto are the hodlers. They're the ones who hold on for dear life. They're like, I'm in it forever. I'm never selling. Why are people selling today? You know, they want to pump it. They want the bubble. They want to pump it, but they never want anybody to sell it because they think that they should never sell. So what they're doing is they're trying to superimpose their worldview on somebody else. You make money when you sell. That's when you make money in crypto. You buy at a lower price, you sell at a higher price. And hodlers, what they're doing is they're actually helping facilitate the bubble. They're helping facilitate that. So do we want to live in a society where our financial system, because that's what crypto is becoming, do we want to live in a society where our financial system is basically a tulip bulb mania? No, we don't. We want nice, sustained, consistent, liquid, free markets. Okay, so the HODL mentality. HODL actually creates the volatility. I just shared that with you. And then finally, hype and rug pulls. This is the other reason we have so much volatility. If you get on social media, you get all over Twitter. Now we have AI bots that are all over Twitter. Well, excuse me, Twix. The social media platform formerly known as Twitter, currently called X. If you get all over X or you're all over Telegram or other Reddit, there's so much hype. There's bots. There's AI bots now hyping and promoting and pumping cryptocurrencies, specific ones. It just depends on which day it is. But they're out there. Push this one. I mean, pump.fun. They literally named the platform Pump. We're just gonna pump it, right? I mean, the fart coin made a bunch of money because people are pumping the fart coin. And then what happens? A bunch of people sell and they pull the rug out and phew. So when you pump it, price goes up. When you rug pull, price goes down and it creates volatility. And there's just something about the crypto market that invites that, which drives some people crazy, but I'm going to actually suggest to you that's the reason you can make money with crypto. That is actually the benefit of crypto. The fastest way to become a crypto gazillionaire is to not hodl and instead to ride the volatility. That is the fastest way to make the biggest fortunes in crypto. So what would stabilize a crypto price? I thought this would be a valuable conversation to have. If we wanted to stabilize crypto, what would it take? Well, the first thing is we got to have more liquidity. So if you've got a project that you really believe in, not only do you want to go out and tell everybody about it, but you want to create a use case for it. You want to create demand for it. One of the things that makes Ethereum useful is there's a demand for the actual crypto. There's a demand for the project. There's a demand for the underlying crypto in terms of day-to-day use. I can only imagine, I'm not going to go down that rabbit hole. Never mind. I'm going to go down that rabbit hole. I can only imagine what the value of Ethereum would be if they didn't have an inflation mechanism. A lot of people don't realize that not all crypto has limited supply. And Ethereum is one of them. Now they have a burn mechanism, but they have an inflation mechanism where it keeps creating. There's actually technically and theoretically unlimited supply of Ethereum. So I can only imagine if Ethereum was as limited as Bitcoin, it would be unbelievably valuable because there's so much demand for the project. And if you want to create a more stable coin for any project that you believe in, the number one thing you can do is create liquidity. And the number one way you do that is create massive demand. There's a project that I'm looking at right now. I'll probably share more about it. I just recently found out about this a couple of weeks ago. But it's a project based in Texas. And the system that they're using is called Texit Coin, if you've not checked it out. The system that they're using, the philosophy, plan, whatever you want to call it, to create stability with this coin is create a huge decentralized demand structure. It is one of the most brilliant plans I've ever looked at, and it's working. It's absolutely amazing. So not only are they creating value They're creating liquidity, they're creating demand, and there's a plan for a huge use case. 99.9% of cryptos never do that. Even Bitcoin itself didn't really have a strong plan. It was a concept. But when you look at a project like Solana, you look at a project like XRP, you look at some of these really big projects, what makes them better in the long run is, number one, there's a ton of liquidity, but there's a great use case with high demand. And what that leads to is it leads to widespread adoption. It leads to trust. And when you have these components, liquidity, strong demand, strong use case, widespread adoption, and trust, your volatility will stabilize. This slide right here is the opposite of a meme coin. This slide right here is the very antithesis of pump.fun. Pump.fun is we're just going to go create a worthless meme coin and we're going to pump it, we're going to have some fun with it, and we're going to do a rug pull. And all the people who jumped in that didn't get out when we got out, they're going to get screwed. That's what pump.fun is. It's penny stock trading with cryptos. That's what it is. That's it. Okay. But a real crypto project with sustainable liquidity and sustainable non-volatility, whatever you want to call it, price action, is going to have these components: high liquidity, strong demand, strong use case, widespread adoption. I hope that makes sense to you. If you got any questions about it, type it in, give me your thoughts on it, tell me what you think. And what I want to talk about next is I want to talk a little bit about how do we profit from that. So that's what we're going to talk about in our Crypto Alpha section. So I made the argument that if you want to have a more stable price, you want less volatility, those are the things that you need. But the real question, I mean, I've never met somebody personally that came into crypto that didn't want to make money. That's the whole point, right? So why, if you come to crypto and your outcome is to make money, why wouldn't we focus on how do you make money with crypto as opposed to how do you hodl it? Hodling doesn't solve anything. It just doesn't. It feeds an ideology, it feeds a concept, but it doesn't solve anything. And I want to teach you how to make money with it. And what I'm going to show you in the next maybe 10, 15 minutes here, I'm going to show you why price action works, the philosophy, the psychology behind it, and why you've probably, well, maybe not, I don't know your background, but why most people are on the wrong side of the trade all the time. And by the time we're done with this, if you don't have a big aha, then please reach out because I need to teach it again. Because you need to have a big aha after this. And what I'm going to share with you is one of the principles, the key principles of Dow theory. Now, you may have heard the name Dow. You may have never heard the name Dow theory, the word or the phrase, but you've heard the Dow Jones Industrial Average in the stock market, right? And Dow theory is named after that guy, Charles Dow. Okay, and Charles Dow, he lived in the late 1800s. He's actually the founder of the Wall Street Journal. His compadre, his friend, co-worker was a guy named Edward Jones. You've probably heard that name before. And they created the Dow Jones Industrial Average. But in his working as a journalist writing for the Wall Street Journal, which he founded, Charles Dow started postulating about price action and why does certain price action happen. And in the process of that, 25, 30 years later, what became known as Dow theory was created. It was basically 6 core principles of why price action happens, what causes the price of a stock to move. Then you can, years later, you can take that into futures, you can take it into crypto and all the other markets. And so I'm going to teach you one of the core principles of Dow theory right now. And the principle goes like this. There are 3 phases of a trend. 3 phases of a trend. When you understand these 3 phases of a trend, you will never be able to look at a chart the same. And I really mean that because everything shifts in your mind. The first phase of the trend is what's called the accumulation phase. The second phase is what's called the public participation phase. And the third phase of the trend is the distribution phase. These 3 phases map out every trend. And we talked about just a few minutes ago, why is crypto so volatile? I gave you some of the underlying reasons. But underlying the underlying reasons, there's a market psychology that's happening. There's a emotion that's driving the market. And we can identify it with these three phases of a trend. Now, this has nothing to do with fundamental value, because the truth is, in a free market, fundamental value doesn't matter. I know some people are going to crucify me for that, but that's okay. I've been taking it for 16 years. Fundamental value actually doesn't matter. It makes you feel smart. It gives you a theoretical of what you think it should be worth, but it doesn't actually matter in the free market. What actually matters is the emotion of the people that are buying and selling the asset. That's called sentiment. And the only way to analyze that is to look outside of fundamental analysis and to look at the price action and see what's going on. And on a grand scale, if you can see these three phases, you're going to understand it so much better. So let's look at each of these. The accumulation phase is this right here. This is when the informed traders start taking on new positions. Informed traders start taking on new positions. Now, what's an informed trader? How do we know that somebody's informed? There's a lot of ways. You could have an insider, somebody that works at the company or works for the project or has inside information that there's some manipulation going on. That would be an informed trader. You could also have people that just simply know what they're looking at and they can read the price action. They're an informed trader. You might have somebody who got a hot tip from somebody who is an insider. They could be an informed trader. It doesn't really matter where their information came from, but the key component is this. They have information that the mass market does not yet realize. They have information the mass market does not yet realize. That's not to say the mass market couldn't know it, but because of distraction, bias, whatever reason, the majority of market participants have not figured out yet what these informed investors understand. And what they start doing is they start taking on new positions. What it looks like leading up to that is the stock or the crypto or the Forex, whatever it is, looks very, very bearish. It looks like it's really, really bad. The news, the sentiment is very, very bad. I often talk about news headlines and I make fun of them because they craft this narrative. When the news is the most bearish, oftentimes that's exactly when you need to be buying. Because what you're seeing is you're seeing the narrative of the emotion. And by the time the news media has figured it out, usually that's when everybody who wanted to sell has already sold. And now it's time to be an informed trader and start buying. Volume is very often low. It appears counterintuitive, contrarian. And these informed investors, they start buying. And I don't mean they start buying. I mean they start taking big positions. They start accumulating their positions. Now, after a little while, the informed investors, they start taking on enough positions, and we've already liquidated the market. And so what happens is price stabilizes and it creates that foundation. Earlier this week, you heard me talking about support. This is where support comes from. It comes from these informed investors that start buying and they start accumulating at a logical price point. And pretty soon the price starts to rise. And as people start to take aware of this, they start to say, you know what, maybe it's not so bad. And they start to get in. And as the people start to get in, the public joins. And we get into this phase of the trend known as public participation. In a public participation phase, what's happening is the public is increasing their participation. Prices begin to rise. Confidence begins to go up. The news starts to become more and more optimistic. And prices move up to the next price level, or something you learned this week called resistance. So you're starting to see the first two phases as the price bottoms. The informed investors start buying, they start accumulating. They buy enough and accumulate enough that it actually stops the crash. It stops the falling. And as they start to keep buying and buying, eventually the price stops falling, it starts rising, the public takes note, and they start buying, and they start to move the price to the next level. Now, here's what you have to understand about these phases. The informed investors, the big money, it's not enough. It's not enough to sustain the market. You hear market manipulation all the time. You hear about this, right? There's not enough money to do that. I'm just going to be honest. What the informed traders do is I'm not saying they don't manipulate, they define the market. They define the boundaries. Because when the price gets down to a certain price point and it's been falling, they start injecting capital and it starts to stabilize everything and prices start to rise. But those informed traders, they don't have enough money to push it from point A to point B. That's where the public comes in. It's where all the masses of the public comes in and it drives from price point A to price point B. And then as the price is getting higher and higher, the news gets more and more and more optimistic. And finally, we get to the third phase, which is the distribution phase. And the distribution phase, guess what happens? The very informed traders that started the move start selling. They start distributing. The news is extremely bullish. The optimism is extremely high. The fears of the previous bear market are almost, if not completely gone. Nobody's thinking about it. And the informed traders who started the whole thing start taking profits. Now, before I get to the next slide and I show you a visual for how this cycle works, I want to ask you a question. How many of you have ever felt like when you get into a trade, as soon as you get into it, it goes down? It's like that's your pattern. And so every time you see something, maybe every time you see Bitcoin going higher, or every time you see XRP or Solana or something, it's taken off, by the time you jump in, it starts going down. And you're like, why am I always on the wrong side of the rocket ship? I get into this thing and it crashes. I get in and it crashes. Why? Because you didn't understand this cycle. You're actually the people that are buying from the informed investors. At the very top, when the informed investors start distributing their positions, who's buying? Remember, I've already shared with you this week that in order for a transaction to take place, there's both a buyer and a seller. So in the accumulation phase, the people who are in a panic are selling. Who's buying? The informed investors. As the informed investors establish their position, as they create that support, public finally jumps in and the public is buying all the way up. We drive the price up with the public participation. When we get to the top, the informed traders start selling. Who's buying? The late adopters. The people who waited. The people who said, well, when it goes back up, I'm going to buy. The people who said, whenever I see that thing trending again, I'm going to jump in. When that thing's already doubled or tripled or quadrupled in price, that's my stock right there. I'm jumping in. I want the one that's already up 4 times. And the people that are selling it to you are the very informed traders who bought when you were panicking. When the news media was the most bearish, when the news media said, it might be done. We may be in another crypto winter. Everybody's freaking out, liquidating their Bitcoin as fast as they can. Save the family Bitcoin fortune. And then you got the hodlers. Hodl, we're hunkering down. Hang on for dear life. We're going to suffer through this crypto winter. They're never selling, so you don't have to worry about them. But the informed traders, they're the ones who start picking up their positions. They establish that bottom. They establish the bottom. The public comes in and drives it to the next price. And we only know what the value should be based on what the market suggests. Based on how far is the public willing to take it. And eventually you get to a new price point. And guess what happens? Those same traders that started it, they start selling their positions and they start to define the top, the resistance level. The people who help define resistance are the very people who help define support. They made it. They identified it. It's not market manipulation. It's just called disciplined behavior. And as the distribution period evolves, it could go one of two ways. It may turn into a reaccumulation period if there's enough demand for it, and then we surge up to the next price point. Or if the public freaks out, once that support is dropped, or once that distribution, that final support line up there is breached, the public comes in a panic selling, and we have a public participation to the downside. And guess what happens at the bottom? When the news is the most bearish and everybody's freaking out and they're screaming, crypto winter, the very traders who sold at the top, the very informed investors, are the ones who stop the fall, they start buying, and they establish the new bottom, accumulating a whole new position. That, ladies and gentlemen, is how market price action works. That is how you make money trading. What you want to do, if you want to make a fortune trading crypto, you want to not be the naive bystander. I mean, if you're not in the market, you're never going to make any money. You don't want to be the easily manipulated emotional trader. You don't want to be the hodler who says, I'm going to hold on for dear life no matter what. You want to be the informed trader. You want to be the one who says, for whatever reason, I can see where this price action is, and I can see where we should start buying. Now, very few of you are going to be inside traders. Most of you just will never have access to that information. I won't have access to that. But what we can be informed about is where the price action is. When we look at a chart like this one right here, and we can see that, oh, the buying behavior is showing up down here, that makes you more informed. And what you're seeing on Bitcoin right now, I'm going to draw this out for you. What you're seeing on Bitcoin is you're seeing this playing out. How many of you were here in the spring when Bitcoin was crashing 25%? And everybody's freaking out and the news is saying, are we going to miss alt season? What's going to happen here? Why are we down? And this, ladies and gentlemen, is exactly where the informed traders started to accumulate new positions. Pretty soon the public came in, drove us higher. This was a distribution period. Where did it show up? At the same previous distribution period. But this time the distribution period turned into a reaccumulation and the public drove the price even higher until we put in a new all-time high. And we established a new trading range between 107 and 122.50 using round numbers. Actually, 122.500, excuse me. Now, inside this, I can change pen colors here, and you'll notice that even inside this, there are distribution and accumulation periods. That's where these pivot points come from. On a small scale, those are smaller time frame accumulation, public participation, and distribution periods. So what's happening right now? Why did I say earlier today, if this support doesn't hold, our next target is in the low 90s, mid 90s, and then it's in the 80s, and then it's in the 70s. Why did I say that? Am I trying to invoke panic? No. I'm just suggesting that once we dropped below this support last week, we had this one. And now that we're dropping below it today, your next target's right here. And if the public continues to panic and sell, you could see this dropping all the way to 75,000. And the volatility continues. Why does the volatility continue? Because there's not enough buyers to pump the price up. And as the selling pressure comes in, what does the market maker have to do? They have to lower the price, trying to attract more buyers. People who said it was too expensive at 107, they might be interested at 90. But as the price continues to fall, eventually we get to a point where we establish a new accumulation period. Prices stop falling, informed traders accumulate positions, and they're going to test it. They're not going to throw their whole bag at it. They're going to test it. They're going to start some buying, see if it starts to hold. If it holds, great. If it doesn't hold, they liquidate quickly. Start some buying. If it starts to hold, they'll buy some more. If it starts to hold, they'll buy some more. And eventually the public comes back in, and guess what? The cycle continues, and the cycle continues. Ladies and gentlemen, if you want to make a fortune trading anything, crypto, stocks, futures, Forex, learn to recognize this cycle right here. I don't expect any of you to be the informed traders that are buying at the bottom. In fact, it's kind of high risk. But if I can teach you to buy right here, if I can teach you to be part of the first phase of public participation, and if I can teach you to identify selling points on the way up, you can make a fortune. And you're moving from a hodler or a naive trader who's sitting on the outside just buying and hoping over to an actual trader who's making money with your crypto. Now, I said this last week, and I'm going to say it again today, and we'll wrap up on this. Crypto's here to stay. DeFi is here to stay. The reason I'm passionate about educating the crypto community is because the crypto traders as a whole have been naive. As you know, it started off with young people. It's just a technology, right? The educated, informed technical analysts, they weren't trading crypto way back then. Now they're here now. But as a whole, when you look at the 500, 600, 700 million people around the world that are trading crypto, and it's going to be over 1 billion by 2030, when you look at 1 out of every 7 people on the planet, they're not informed traders. They didn't know how to do this with the stock market, and they certainly don't know how to do it with crypto markets. And so they're buying into the narrative of buy and hold. They're buying into HODL. They're buying into this idea that I never ever sell. When the informed traders, the ones that actually know how to trade, they're coming in droves. I mean, now we're getting ETFs on Solana and XRP and all these cryptos. The real big boys are here. It's no longer they're going to come one day. They are here. And I'm telling you, you got a 5-year window maybe before the majority, it's going to flip. Right now, the majority of the money is still over on the traditional equity side in stocks. And I mean, they're issuing crypto in the ETF market, right? 5 years from now, it'll be the opposite. 5 years from now, you'll be having crypto on chain that is essentially an ETF version of a stock that's off chain. And that's going to be an amazing day. Imagine trading on a DEX, on a decentralized exchange. Imagine going to DEX Trade or 1inch or any of these decentralized exchanges and trading your USDC coin and getting a tokenized version of Apple stock that's trading off chain on the stock market. Whoa. In 5 years, that will be happening. There's already people that are working on it. The projects are there. The technology's there. We just got to get through all the red tape. We just got to get it issued. So folks, what I'm teaching you today is I'm not just teaching you about crypto. I'm teaching this is how the financial markets work. And the sooner you learn this and the sooner you understand it, the sooner you're in a position to actually make money for the rest of your life trading. And if I can do that for you, then I've given you a gift, and that's what I want to do. So I hope you've gotten a lot from this. I hope you've taken some great notes and some great lessons. If you want to learn more, you know where to find me. I'm over at trademaestro.com, trademaestro.com. We've primarily been teaching stocks and options trading over there, but I do have some crypto courses, and I would love the opportunity to help you take your trading to the next level. Listen, if you have not liked and subscribed already to the channel, I don't know what you're doing. I mean, surely by this point, you've realized that you should be following me on Rumble at Trade Maestro, or following me on YouTube at Trade Maestro, or if you're on Telegram, then you can follow us, Real Trade Maestro, and over on Facebook, it's Trade Maestro Official. I'll get the X page up soon. I don't know when. It's just so many moving parts. And I'm doing all this myself. So if any of you really want to help promote the show, then I would really appreciate that. Reach out. Let me know. But trademaestro.com, that's where you can find us. And like and follow, like and subscribe. Share your notes below. Let me know what you think. And I wish you the best. I'll be back tomorrow, same time, same place. Until then, happy trading to all of you. Have a great day. We'll talk to you soon.